Hello, I'm with John Pattullo, co-manager of the Henderson Strategic Bond Fund. This fund has been on our core selection buy list since March 2006, and as such is the longest standing strategic bond fund on our buy list. John.
Morning.
If we don't mind starting just talking about the climate for corporate bonds, there's been a lot written recently about liquidity concerns in corporate bond funds due to the high inflows that have been in the IMA sector. Would you maybe make a bit of comment on that?
Yeah, no, of course, it's a very relevant and topical subject for the listeners. I mean, liquidity in corporate bond markets is poor. It's been poor for years, and it's probably getting worse as banks commit less capital to making markets. It's something we're very conscious of in the Strategic Bond Fund. We have a number of different asset classes which have different market makers and hence have different pools of liquidity. In addition, we use credit derivatives which can't manufacture liquidity, but it does mean that you can hedge out a position which you might be long of and hence neutralize the position. In addition, we run quite high cash levels. I think a lot of my peer group tend to run about 10% cash, and that gives the clients, should give the clients some comfort that if they did want to take money out, it's there. And finally, we have dilution levies, where so essentially if clients take in or put out a large amount of money, there is a cost associated with that, and the client would correctly be charged that cost.
And what about gilts? And there's been a lot written about gilts getting more overvalued and the yields being so low, and this has been a trend which has sort of persisted a lot longer than I think most people thought originally. Where do you sit with view on gilts, and what have you been doing with them recently?
Yeah, well, this year we have actually been long them, so we've had exposure to the interest rate curve, and as you say, gilt yields have come down, and that's been good for the fund holders. We're of the view that they're generally expensive, and they're expensive because we are a AAA nation and people want to safe haven in their cash, which is completely understandable. On a valuation perspective, they don't offer any value at all. So essentially we've been in and out of them on a tactical basis using interest rate futures, and that's worked well. UK GDP is probably, the official GDP numbers we think are worse than they actually are, and there are some signs that the UK economy might just be ticking up a little bit from the current shrinking state it's in. So we're a little bit shy, and I'm sure we'll get on to the Bernanke and Draghi action over the last 2 weeks, and hence our duration is actually quite low for the year. It's actually probably the lowest it's been year to date. It has been up at 7, and now it's just under 4. So we're kind of pragmatic about gilt technicals, and one shouldn't get too bogged down in the valuations, which I think anyone would accept are expensive.
Yeah, and then I suppose on to the central bankers and promises made by Draghi, and last week only the introduction of QE3 with sort of never-ending purchase of mortgage-backed securities in the States. How do you think that affects the bond markets and maybe the different buckets in which you can fish from gilts all the way up to high yield and mortgage-backed?
Yeah. Well, I mean, I watched the whole press conference on last week, and there was a mindset change in Fed thinking. As you know, they have a dual mandate of inflation and unemployment, and basically the mindset of Bernanke is now let's get unemployment down, and that may cause some higher inflation down the line. And I think that is very pertinent for bond managers and equity managers. So essentially, it was a very powerful statement. It was remarkably dovish. It's a bit like everybody's been given a kind of vodka Red Bull injection, if you like. And so liquidity is getting pumped in the system by the Europeans and the Americans. That's very good for risk assets. And
so what, more favouring high yield?
Yeah, more assets which are more credit sensitive and less interest rate sensitive. So we added risk using derivatives. We added some high yield names as well. So more high yield and less sensitivity to the gilt market. So we actually reduced some of our sensitivity to the gilt market, again using derivatives, hedging out some of our investment grade book, which has performed very well year to date. So essentially bring our duration down and increase our credit risk. And as a backdrop, it's very good for risk assets in general into year end, of which we're quite bullish into year end. The caveat being, of course, liquidity. Fueled injections are good short term for asset classes. Quite bad for, and up in oil prices, so quite bad in some senses for some consumer groups who are very dependent on petrol and stuff going into cars, but generally a good backdrop. Longer term, though, we do have...
To say be mindful of inflation.
Yeah, longer term, mindful of inflation, and mindful that longer term, a lot of European countries just have too much debt, and I don't think they're suddenly going to grow on the back of this. So we still think there's going to be some sovereign write-downs in a number of European countries in a number of years down the line. But short term, yeah.
So they're just putting
positive.
putting some of the problem off for the
Exactly,
short term.
and they're doing it in a very powerful, concerted way. The Europeans and the Americans, and we're 4 or 5 years into this crisis now, and we're still making
going.
monetary conditions more supportive. And if anything, the Fed is actually a bit behind the curve. It's almost they're saying, we'll keep stimulating this until we are confident that unemployment has momentum and is coming down, and we'll keep pushing on to make sure that momentum kicks in and the US economy starts growing. So remarkably dovish, and most of my colleagues were quite surprised by the bluntness of it.
John, thank you very much.
Thank you.